Hi, everybody. Thank you so much for tuning in today. My name is Brooks Kelly, and I'm going to talk to you today about DSCR loans. And what does DSCR mean? It's debt service coverage ratio loans. Now, you still don't know what that means? Well, it's because it's a newer loan to the marketplace, and it's specifically done for investors who want to buy homes without having to qualify by showing their tax returns, their income, or anything like that. So, DSCR in the basic means that you can use the rental income from the property in order to qualify for the home. So when you're purchasing a house with a DSCR, you do a rental analysis or a 1007 appraisal along with your normal appraisal. So we're both going to get the value of the home and the rental comps for the neighborhood. And then we're going to qualify based on that. So there's different debt service coverage ratios that you're allowed to qualify with. When these loans first came out, you had to qualify with at least a 1% ratio, meaning that the rent was at least as much as the total payment, including principal, interest, taxes, and insurance, and assessments like HOA dues. In the recent years, these have morphed a little bit. Investors have gotten a little more comfortable with them, and so there's opportunities to get them with a lower than 1% ratio. Even some investors allow all the way down to zero, meaning they don't even care what the rent is as long as you got enough money and enough credit score, they'll qualify you based on a 0% debt coverage ratio. Now, the lower the ratio, the higher the interest rate. And these loans have a decent interest rate these days. Like, they are not far off of where Fannie Mae and Freddie Mac are the ones that make the rules and the rates for normal conventional investment properties. So if you can get a close to market rate with one of these products without having to jump through all the hoops, why wouldn't you go this direction? And a lot of investors really love this. And one of the main reasons that they do love this is that they can title the property in their LLC. And they can have individual LLCs for every property too. It's one of the biggest questions I've gotten from investors over the decade plus that I've really focused on investment property financing. I taught many courses at the local community colleges. I've done hundreds of loans for investors. And that's always the first question is, can I title this property in an LLC? And if you're going to go with a conventional loan, the answer is no. But with these business purpose loans or DSCR loans, they allow you, and actually a lot of them encourage you to do it in your LLC. And that way you take away some of the liability or personal liability that you have as an owner if the property is titled with the LLC. And they also have an unlimited appetite for these loans, meaning that they'll do 10, 12, 15, 20 of them when conventional financing typically limits you to 10 finance properties at one time. So this opens up opportunities for investors that want to park their cash in hard assets like real estate. And these products have taken off. I think 16% of the market is now using non-QM loans, which are like bank statement or P&L loans, or most popular are these DSCR, debt service coverage ratio loans. So let's dive into a lot more of the details and how these work. First, I'm going to talk about all the different uses that you can use these for. You can use them to purchase a home. You can use them to refinance a home. You can use them for a condo, a townhome, a duplex, a triplex, even up to 8-unit properties are allowed with these types of mortgages. So it's really unlimited in what they're willing to look at. Another big purpose for these is non-warrantable condos. Condos have gone through a process over the last couple of years after that condo collapsed in Miami, Florida, where Fannie and Freddie are really looking hard at the condo association, the insurances, and everything that pertains to the warrantability of the condo. And there's reasons why that investors will finance and that they won't, but the most stringent is going to be inside that conventional financing bucket. Well, when you go outside of that, typically the interest rates rise significantly. But in these DSCR loans, you don't have that same issue as long as it's a decent warrantability issue, meaning it's not a catastrophic issue. HOA is not in a lawsuit of epic proportions, or there's not any issues that are catastrophic in nature to the structure of the condo complex itself. The different types of loans that come in this are interest only, which is a big thing right now. And there's some investors that will allow you to qualify based on the interest only payment that's in the DSCR ratio. You can also do 30-year, 40-year notes, or ARMs that are 5 or 7-year ARM loans. Typically, most of them are done on 30-year fixed, but there are outside the box options with this that allow for different creative qualification scenarios. As an investor, you're always looking for an angle, and if you can make the property cash flow more, it may work into your benefit for finding the right property for the right tenant. Now we go into qualifications for it. Now, the major qualification, like I told you, is the rental income itself. Now, you have to go outside of that because not everybody can get these loans. You look at the credit score as one of the main factors. Now, 640 credit score is the minimum. The higher the credit score you have, the better the interest rate becomes. You also have to have at least 20% down to put on these properties. 25% or 30% will land you a lower than market interest rate. But 20% is the normal, and it's not as big of a hit as when you're looking at a Fannie or Freddie type loan. You also have to have reserves in the bank. They're going to look to see if you have money in the bank after closing in order to make a few mortgage payments just in case you don't have a tenant move in right away. The reserve requirements aren't as stringent as what you'd think they would be. Typically, it's between 3 to 6 months of the full property payment of your full PITIA. Now let's look at the bad side of them. And it's really not that bad, but it's something you got to be aware of when you go into one of these loans, and that's prepayment penalties. Anytime an investor is willing to do one of these loans, they want to be secure in the revenue for a certain period of time, or you're going to pay an additional fee. Prepayment penalties are a thing of the past, and they haven't been on any mortgages really for the last 15 or so years since the Dodd-Frank Act was passed. So on these investor type loans, the company that's funding the loan wants to be secure in the fact that they're going to get paid for a certain period of time, or they want to be compensated for it. So they have prepayment penalties, and you can look at the different interest rates that go with them, anywhere from 1 to 5 years. The longer the prepayment penalty, the lower the interest rate goes. The shorter the prepayment penalty, the higher the interest rate goes. So many times we kind of marry the two together depending on the goals of the investor and what we think the market's going to do. Typically, we show 2 and 3 year prepayment penalties because we think the market's going to cycle, but you just never know. So what is a prepayment penalty? Well, it's a percentage of the loan amount. So depending on the investor and what their requirements are, it's going to be a different percentage based on how many years the prepayment penalty is. So it's different in every aspect, but it's a percentage of the loan. So I quoted one the other day with a 3-year prepayment penalty, and if they paid it off in the first year, they had to pay 3%, second year is 2%, last year was 1%, and then after the 3 years, there's no penalty whatsoever. So basically, they were locked in, but they always have an out just in case you need to sell the property or there's an opportunity to refi for a lower and better rate. So just to recap, these loans for DSCR, or debt service coverage ratio, are made for investors that want limited documentation. They don't want to show their tax returns, or they don't have enough income to show, or they're professional investors that have multiple properties and very complicated tax returns, or they want to invest the property in their LLC, or they just like the ease of the product. And it's a very easy product to go with. You got good credit, money in the bank, decent rent on the property you're going to buy. Like, it's a slam dunk approval. If you want more information about other loan products, the way loans work, what the process looks like, follow my YouTube channel. There's going to be tons of videos coming out that talk about all the different products that are available and how they work in this crazy, crazy mortgage industry. So make sure you follow, subscribe, comment, and do what you're supposed to here. So thank you for tuning in. Have a great day.